You tap your card for coffee. 6 cents vanish into the payment system. But here's what nobody tells you. Some merchants pay 10 times that amount. And those massive fees, they're fueling the fintech gold rush. If you're into hidden financial systems and how money really works, hit like and subscribe. This is the story they don't want to tell. Every card swipe triggers a fee. Most businesses pay 2 to 3%. Your coffee shop pays $3 on a $100 sale. But for high-risk merchants, supplements, travel and tourism, CBD, subscription services, rates skyrocket to 5 to 8%, sometimes higher. Same $100 sale, $8 in fees, nearly triple. Why? Traditional banks won't touch them. Too much chargeback risk, too much regulatory scrutiny, too much liability. So they turn to specialized processors who charges accordingly. In 2024, US merchants paid $187 billion in card fees. High-risk merchants contribute a larger share of total fee volume, effectively helping sustain the same payment infrastructure that keeps global commerce running. While Visa earns just pennies on each transaction, specialized processors earn dollars. Because they handle the payments, no one else can. A high-risk merchant processing $1 million each month at a 6% effective rate generates about $60,000 in fees monthly, $720,000 a year, from just one account. That's what sparked the modern fintech gold rush. Not serving coffee shops or boutiques, but powering the businesses traditional banks turn away. These aren't household names like Stripe or Square. They operate quietly behind the scenes, enabling entire industries that the mainstream ignores. Take a supplement company doing $10 million a year at a 6% rate. That's $600,000 in processing costs. That's the price of access to the global payments system. Because certain high-risk verticals are prohibited by traditional processors. Without specialized processors, those transactions wouldn't even happen. The math is staggering. Standard processing at around 3% generates billions. But when you move into specialized verticals with higher risk and compliance demands, the margins and the opportunity both multiply. So why do these merchants pay more? Because they operate in industries with higher chargeback exposure, more fraud potential, and stricter compliance oversight. Traditional merchants might see 0.5% to 1% in chargebacks. High-risk merchants might face 2 to 3%, roughly double. But the real difference isn't just in numbers, it's in management. Processors in this space carry heavier liability, advanced monitoring, and constant audits. They maintain reserves, absorb risk, and keep merchants online when others can't. That added infrastructure is what justifies the premium. In short, these businesses are compensating for their higher risk profiles and higher fees. They're paying for reliability, compliance, and continuity in a world where traditional banks say no, and for the processors and agents who specialize here, that complexity is what turns ordinary fees into extraordinary opportunity. Standard processing, an agent earning 0.5% residual on a restaurant doing $50,000 monthly makes $250. High-risk processing, agents earn 1 to 2% or more. Sign a supplement company doing $200,000 monthly at 1.5% residual, $3,000 per month from one client. Build a portfolio of 10 such merchants, $30,000 monthly, $360,000 annually in passive income. Some agents have built 7-figure annual incomes purely from residuals in this tier, not by signing hundreds of clients, by signing dozens of the right ones. Here's the controversial part. These businesses are legitimate operations. Nutraceuticals, online dating, firearms, kratom, travel agencies. Even some e-commerce gets flagged for selling internationally or offering subscriptions. They're not criminals. They're businesses paying premium fees for payment processing, legitimate but labeled risky. Processors defend high fees by pointing to chargebacks. When customers dispute charges, processors eat the cost if merchants go bust. But here's reality. Processors have gotten sophisticated. They require reserves, 10 to 20% of monthly volume held in escrow. They implement fraud detection, they terminate merchants exceeding risk thresholds. Well-managed businesses in this tier maintain chargeback ratios under 1.5%, not dramatically different from standard merchants. Yet, they're still paying triple. The truth? High fees persist, not because perceived risk and market leverage. The processors have power, the merchants have no alternatives, so fees stay high. Becoming a high-risk payment agent isn't for beginners, it's for professionals who want to operate at the top of the payments industry. These merchants aren't small-scale shops. They're sophisticated operators running large, fast-moving businesses that depend on advanced processing solutions. They expect expertise, transparency, and real results. If you can deliver that, your commissions can easily outperform standard processing. If you're technical, there's huge demand for support tools, chargeback management systems, fraud detection software, payment routing optimization. High-risk merchants value reliability, so they're willing to pay for technology that helps them process securely and efficiently. Merchants operating at 6% effective rates are always looking for ways to streamline, help them negotiate smarter contracts, lower chargebacks, and structure their businesses to qualify for better rates. When you create measurable savings, your consulting fees and long-term relationships grow fast. If you can build a compliant, tech-driven model that serves these merchants responsibly, you can undercut legacy processors and still enjoy healthy margins. That's how many successful fintech firms started, by serving the merchants others overlooked. The high-risk payments world is more complex, more regulated, and less visible than standard fintech, but it's also more profitable, and it's enormous. Specialized processors quietly handle tens of billions in annual volume, often at 2 to 3 times standard processing rates. If standard processing at around 3% generates billions in profit, imagine the potential at 6 to 8%. In a space that rewards knowledge, relationships, and execution. The fintech industry won't advertise this. The gold rush isn't equally distributed. Standard merchants provide volume. The high-risk tier funds the profits. Processors extract maximum value from those with no alternatives. It's not illegal, it's just business. But it's also an opportunity. Where there's inefficiency and price discrimination, there's room for disruption. Merchants paying 6 to 8% would happily pay 4 to 5% to a fair processor. That's still double standard rates, still highly profitable, but it would save businesses millions. Nobody's doing this at scale yet. Most processors prefer the status quo, maximum extraction from a captive market, but someone will eventually build the fair trade high-risk processor, transparent pricing, reasonable rates reflecting actual risk, technology-driven efficiency passing savings to merchants. When they do, they'll capture massive market share. Maybe that someone is you. The fintech gold rush isn't powered by coffee purchases. It's powered by businesses paying triple rates because traditional banks won't serve them. Those supplement companies, gaming platforms, subscription services, they're funding the infrastructure, generating the fat margins, building fintech empires, just not their own. Next time you hear about a payment processor's record profits, ask, who's really paying for that? The answer is the merchants nobody talks about. Businesses processing billions at premium rates with no alternatives. Legitimate operations labeled too risky for the mainstream. This is the two-tier system where some pay pennies per transaction while others pay dollars. Where standard merchants get competitive rates while high-risk faces gouging. It's real, it's massive, and it's how the fintech gold rush is really being funded. The question is, will you keep watching from the sidelines or find your angle into the most profitable tier of payments? Every high-risk transaction right now generates premium fees. Someone's collecting. Why not you? Comment, guide me for a free step-by-step breakdown. Thanks for watching Profits from Payments. Hit like and subscribe for the financial stories they don't want you to know. Remember, the biggest money flows where nobody's looking.